Hey everybody, welcome back to the channel. I started my process with real estate syndications, investing in apartments early on. But as I started to diversify a little bit and branch out, I always wanted to invest in an unbelievably cash flowing space, but it was very hard to find mobile home parks. And today I've got Jack Martin with 5210, and we're actually going to do a little bit something different. We're going to kind of role play a little bit for the new type of investor that's looking to get in syndications. We're going to get all of your questions answered. So Jack, welcome to the show.
Well, thank you for inviting me. I'm excited to share some years of experience and wisdom with people. This will be fun.
Absolutely. So for people that don't know you or much about your company, give us a little brief background for us.
Well, I'll back up just a little bit and give you like a 10,000 foot view. So, okay. Military guy, born in a huge family in the Midwest, got into real estate as a developer, building spec homes 25 years ago. Then I got into single family homes and did about 2,000 single family homes with a partner. Got burnt out of the single family space and got into apartments. So we did multifamily for several years. And then I tripped over this thing called mobile home parks. And it was kind of one of those aha moments when I understood their recession-proof qualities. I knew that I had to build a business around it. So business partner and I, Nate Petty, we started in 2016 building our first portfolio. We're in the process today, as we record this in the spring of 2023, in the middle of building our second portfolio. And all we do is mobile home parks. And for the reasons that investors love them, we've chosen that as our vehicle to drive in the business, because the next time a 2008 market crash occurs, we and our investors don't want to be exposed to loss or risk. So that's why we do it.
Excellent. So when we mentioned a little bit before we started recording how we kind of wanted to structure this particular time together. So I've had, as I mentioned before, I've already had several calls this morning from physicians and dentists that have not yet invested in real estate syndications. Okay. Mm-hmm. So I want to play that person, because I want to give you like a lot of the questions that they're asking me as somebody that's invested and both on the limited partner and the general partner side. So maybe let's start at the beginning. If somebody's out there, if they're a physician, dentist, if they're a busy professional relying on one stream of income, in general, why do you think maybe they should look even into real estate syndication? Not just mobile home park syndication, but just in that space.
Yeah, so all of the real estate investments are considered alternative investments. Alternative meaning that they're not traditional market-based investments like stocks, bonds, mutual funds, and those kind of things. So particularly when you start to zoom out and look at the whys underneath real estate investments, the top item that shows up is you own a real asset, and it produces cash flow. So managed correctly, it should have a cash flow dividend. So even through times where you see market volatility in stocks, potentially some event that you can't control could wipe out a portion of your investment capital. So if you invest in the right kind of real estate and it's managed correctly, you are less exposed to loss of principal, and then you have a constant coupon that comes in the mail or deposited in your bank account of cash flow. And then there's tax advantages that are associated with owning real estate as well. So in the best cases, even though you're earning an income, the passive losses that you get from depreciation will cause you to not have any exposure to paying tax. So it's quite a bit different investment. Most people, not being familiar with it, they think they have to roll up their sleeves and do the work. But investing with a professional that does that for a living, it's the experience can be very similar to investing in a market-based investment, where you're not doing it, you're hands off. I mean, if somebody who invests in Apple is not over there designing the next iPhone at the company, they're just investing in, or they're leveraging the experience of that company. So in a similar fashion, when you invest in real estate with a private sponsor, you're leveraging their experience. That's what you're doing.
Excellent. You know, for me, I mentioned to you on a previous call, my wake up call was when I was snow skiing, injured my wrist. My kids were young back then. I think they were 8 and 6. They're teenagers now. And that was my wake up call to, if I couldn't use my hands, because we're pretty much a one income family, I couldn't provide for my family. Yeah, I do have disability insurance, but you know, it wouldn't be enough to cover things, you know, especially if something happened indefinitely. So that's what got me started down the road, you know, for like passive income. So just in that aspect, you know, what are your thoughts about just having other streams of income coming in for somebody like that?
Yeah, diversification is commonly looked at as a smart strategy. So, you know, obviously, because I'm in mobile home parks, like I believe in this asset more than other real estate for the right reasons. So I invest alongside of our investors as well. And I think mobile home parks are the best investment. But I completely understand that when the stock market crashes and it's at a low, like we saw in previous, like the great financial crisis, like allocating to the markets when it's depressed makes sense as well. So you can gain, you know, I look at mobile home parks as kind of the tortoise and the hare. It's the tortoise. It's, you know, will win the race, and it's very certain and predictable. But it's not sexy. I mean, they're mobile home parks. It's not Apple stock. So if you could have bought Amazon stock, for example, after the 2000 bubble crashed, you'd probably be patting yourself on the back. So I think diversification makes sense. And one investment won't perform like the other. One investment will have tax advantages the other won't have. One investment will have cash flow dividends and the other will not. But one's got a higher degree of risk than the other. So I think it's about allocating to your portfolio where you feel like this amount of capital deserves to have low risk and this amount of capital deserves to have some high risk. And that seems to be a pretty intelligent strategy for people.
So one of the things that people ask me a good bit, you know, by the time they find me, whether it's my YouTube videos or blog articles, they know a little bit about how the real estate syndication process works. Most of the time they're real timid. They don't, it's all about trust, you know, finding the people you can trust. So one of the questions that they ask is, you know, they ask me, you know, how do I find the people to work with, you know, such as yourself? And then I kind of explain to them. And then the other question is for you, Jack, is now that all these sponsors like 5210 and the other ones, because of the Tax Cut and Jobs Act, can advertise these, solicit these on, I mean, you go to Instagram and Facebook now and see, you know, all these deals, you know, apartments or mobile home parks or whatever advertised, they all look the same. You know, they're all pretty much stating the same numbers, a lot of them. So it's like, well, Jeff, how do I tell if the deal's good or not? So how would you answer that question if you were asked that?
A great question. So when I look at educating investors who haven't done this before, or maybe they're just not familiar with it, there's a half a dozen things that are extremely important to get right or to understand and get comfortable with before anyone should invest, especially if they've never done it before. And we can walk through what some of those things are. But the truth is that the most important thing to get right is the people. So a deal is a deal is a deal. While I say that, like that's going to be another thing that's important, but it's difficult to look at a snapshot on Instagram that says, hey, invest in this project and make 14% or whatever they're advertising. When you think about people. It's really about the character of the sponsors and their track record. It embodies those two things. And I think if you could kind of think on the human side, the most important thing to get comfortable with is, will these folks make decisions that's in the best interest of all parties when nobody's looking over their shoulder? That's the most important thing to get right. Now, how do you find them? I think the best way to find them is through referrals. So if somebody that you know has a relationship with them that goes miles beyond a cold introduction or clicking on a link on Instagram, those people who have experience that of it being invested with a sponsor are going to be able to offer insight that you really have to trust the sponsor or whatever advertising or content that you find about them. You can do background checks and you can do due diligence on a sponsor, and that's smart as well. But the best introduction to a sponsor is, hey, I've had experience with this guy for 5 years already, and everything that they say they're going to do, they do, and the yield expectation they promised is being met or exceeded. I think the best way to find somebody is to be introduced to them through somebody who already has a purview into their entire enterprise. So that could be accountants that have clients that invest in syndications. It could be attorneys. It could be, like in your case, somebody who really understands what it takes to be a good sponsor. There are third-party fund administrators out there, and they won't necessarily give guidance, kind of like an investment advisor can't steer clients, but they'll say, hey, I've done my due diligence on these guys, and I know that they're worth exploration. But I do think that word of mouth is the absolute best way to be introduced to something like this.
Yeah, I couldn't agree more. And when people ask me this, a lot of times I'm speaking to physicians and dentists. I give them this analogy. I say, look, I graduated with 58 people in my dental school class, and I would only let about 5 of them work on me.
There you go.
But they're all dentists.
Meaning
there's a ton now. You see that you can solicit these deals. There's a ton of syndicators out there. What's even more scary is, and I'm not going to mention these groups, but I've been to some of these groups, like with hundreds of people, these meetings, and what it is, they invite all of these people that have been limited partners, and they say, hey, come here and we're going to teach you how to be a general partner. And then they just pool all these people together with zero experience, and they go out, and then they're raising money, and then they have zero experience. And there's tons of those out there, and you just got to be really careful. So again, the track record, the referral is important. I'll never forget this. There was a podcast I was listening to, and this guy was an attorney for this billionaire's family office. And there was he wanted to diversify, and he was looking at a real estate syndication, had a long track record. He said, what's your typical deal like? And he told him the structure, and he said, what's the typical hold period? He said 7 years. We got 2 going on right now that we're in the process of 7 years. And he went through his whole thing. He said, okay, well, I'm going to put a note on my calendar to call you in 7 years. Click. And that's what that guy did. I mean, he's listened to the whole spiel, said, okay, well, we'll see if you can walk the walk. And he would wait, and then he would go back and look at, hey, what did you say your projected returns are going to be, and what were your actual returns going to be?
Yeah.
So I thought that was very impressive.
Well, that's interesting. It brings up, I remember when I was an apartment syndicator. Well, we did single family homes first, and then we got into syndicating apartments. And those were a little bit more short term. So 2 to 3 years to acquire, renovate, add value, and then resell it. When we got into mobile home parks, it's a longer term strategy. So we're buying these for 2 reasons. One, we want to own assets that can weather a recession better than anything else. So when an unexpected event shows up, we're not concerned about it. We just keep operating as usual. Maybe the conditions for a sale would not be optimal in that kind of an environment, but at least we have cash flow. So worst case scenario, we want to have cash flow and preservation of capital. When I started doing mobile home park, well, the other side of it was it's a smaller niche. There's less people doing it. It's harder to get into the mobile home park space. So there's less competition, and it's harder to turn the wrenches. It's not an easy thing to do. The outcome is more stability, but anybody can do an apartment. Just go to a seminar and, be intelligent and surround yourself with good management, and you can do an apartment. But mobile home parks are much more difficult because they include ownership of the homes by the residents. There's just a lot more work involved there. But when I started raising capital for our first deal, let's back up 8 years ago, the question that I got from many of the investors that I was speaking to was, how many of these have you done? So all of the track record associated with development deals, single family homes and apartments, like that was great. They liked that track record, but how many mobile home parks have you done? So, well, this is our first one. And it's a very similar response. Well, call me after you've done 3 or 4 of these and then we'll talk. But what's really neat is that those guys have been following me for 7 years now. And they've been dripping into our funds when the doors open at intervals, because they've seen us not only continue to build a solid business, but also the comparison to what we projected when we acquired these assets, and then where we are against that in actual performance. We're about 2 years ahead of what we projected on every asset that we own. So it's a patient way to invest, especially when somebody's new. Like, that's probably the last guy that you should invest with, is the first time syndicator who just went to a seminar and he's just getting started. So getting the people right, I think from a character perspective, is probably the most important thing. But then when you add on top of that a track record that they already know what they're doing and they've done it and they've overperformed their projections, that tends to be a pretty good recipe for success.
One of the things that really stood out when I spoke with you previously is the number of deals that you said you guys passed up either last year or this year, which was unbelievable. And I think you said they were all off market. So if you can share a little bit about that number, and then what makes when you're looking at these deals, what makes a deal good to you to actually move forward and make an offer?
Yeah, and again, this kind of goes back to the people. So especially in an environment where you're investing in a fund, where you're essentially investing in the track record of a sponsor, it's really important that you're comfortable that they're buying deals that are going to be accretive to the fund. So last year, being 2022, was an interesting year because interest rates essentially doubled. So in the mobile home park space, because owners know what they have, these are cash flowing assets, they're not in a hurry to sell them. The only way that a sale or a transaction could occur is if they were willing to lower their price to meet the current interest rate environment. That was really difficult. They don't really want to do it. So the only assets that were trading in 2022 were ones where the owner had to sell. So they had debt that was maturing, or they were at the end of their ownership life cycle for whatever reason. We looked at 142 deals last year. We looked closely at about a dozen of them. We made an offer on 6 of them. We put 1 in escrow, and then we backed out because the seller was playing games, and it turned out to not be what he demonstrated. So it was difficult. Our business doesn't grow unless we're buying deals. But the lens that we look through is, on a conservative basis, can our investors make 15% on an IRR on an annualized basis? And if the answer is yes, we take a closer look. And if the answer is no, then we take a pass. So, we'll talk a little bit more as we get further down the road, the importance of a deal pipeline. But we have a very powerful deal pipeline internally, where most of our relationships and the reason why we find deals is directly with the owner of the asset. And then some of the deals that we see come from brokers who specialize in off-market deals. So we're not chasing or competing with other buyers where on unlisted assets or publicly listed assets for sale. We're seeking, we know the assets that we want to acquire. We know what they look like. And we'll just build a relationship with an owner or a broker until that owner makes a decision to sell. So it's a very patient waiting game, but we're not interested in deploying capital just to deploy capital to help out some vanity metric. We're looking at, we want to buy home runs that make sense, where we can make money and our investors can make money together. On a conservative basis, we know they'll survive a recession. And we're confident that a minimum IRR of 15% can be met. Otherwise, we just don't buy a property. So probably a little bit more conservative than other groups out there, but we don't have the pressure to deploy capital. We're building a business and we want to love the portfolio. We're getting married to these assets for 7 to 10 years. We want to love them. So it's we're buying properties for the right reasons. And I think it goes right back to the people. If you get the people right, they should be doing that. Instead of because you could color underwriting to look pretty on a deal that's average. If you really wanted to, we tend to take a little bit different approach. I mean, one of the things that you find, like in real estate, just like any other business, things don't always go the way they're planned. So if you stress your underwriting and everything has to hit just perfect in order to achieve the investor IRR, the likelihood of all of them hitting is it's not high. So instead, leave yourself, what we call cookies in the pantry, so that you have these extra areas where there's a possibility of overperforming, and kind of underwrite to more of a worst case scenario. And then if you don't get any surprises, then you're going to overperform. So much rather be in that kind of a scenario. And that's why we looked at so many deals last year. We didn't buy any because the underwriting was too tight, and you had to, there wasn't room for conservative cookies in the closet. So we just didn't buy those. So I think the second thing, just to kind of share a little bit, that I feel is extremely important, and new investors are probably not going to ask the question that they should be asking, which is, most people get enamored with how much money can I make? And they should be asking, how can I be confident that I'll get my money back? Or how much money can I lose? They should be looking at that as well. So, in real estate, as you know, all real estate is not created equal. And if you look at a spectrum of risk associated with real estate, typically the potential for yield will be correlative with the risk that you're willing to take. So investors who are seeking a really high yield should be investing in things like speculative development projects. But the challenge that you have with those kind of investments is that if the music stops, you probably will lose all of your investment capital. So if we go back to 2008, 9, 10, I mean, how many unfinished development projects did you see? They were everywhere. And those ones, all the investment capital was lost. So in our view, and this is why we chose mobile home parks, is that if you look at that spectrum of risk, mobile home parks are on the lower end of that risk spectrum. So the likelihood of loss of principal is extremely low. So, get the real estate right is with respect to your appetite for risk. So the higher risk you take, the higher yield expectation should be there. The lower risk you take, the lower the yield expectation will likely be. So you don't want to go compare two investments side by side and stare only at the potential for return or yield. You also need to understand the comparison of risk. So I think investors that are new to the business, maybe they don't appreciate the potential risks, but they should be looking at those. Is there sustainable demand that will occur through a recession or a COVID event or a 9/11 event or something of that, or a market correction. If an event like that occurs, is it possible? Like, what's the potential for loss, and then how severe could the loss be? They should be analyzing that, or at least asking questions around it with whomever they're seeking to invest with.
Excellent. Well, we haven't really talked much about your company, 5210. Well, we talked a little bit, but if people want to learn more about it and the different mobile home park offerings that you have, how do they do that, and kind of what's involved with that process?
Yeah, the easiest way for people to connect with us is just to go to our website, and you can see it right up there, 5210.com. And everything that they should need from an education perspective will be there. Our current offering, right now we have Fund 2 open, but that'll, if somebody's watching this in 3 years, that'll be different. There's a way to get in touch with us. There's a way to schedule phone calls on our calendar. There's a way to follow along and just kind of observe. We don't always have an opening for new investors to come in, but we typically always have an appetite for educating investors and allowing them to save a spot in line for the next time we have an opening. We're not a high volume, get over your skis kind of company. We're more patient, diligent, purposeful in the way that we do our business, and we tend to attract people who are seeking that kind of experience.
Excellent. Well, we'll make sure we'll put the link below the video. Pretty easy to remember, 5210. If you're listening to this and not watching it, that's the numbers 52 and then spell out 10, 5210.com, or you can just Google 5210. And I appreciate you taking the time today to educate, hopefully, those out there that have watched or listened to this that are new to the syndication game, got a little more insight, got a little more value. Really, you really want to focus on finding the people that you can trust to invest in. That's the main thing that we preach. That's the thing that today, Jack, that you preach. So we appreciate that. Anything else that people need to know that maybe we haven't discussed?
Yeah, I could probably, there's a couple more things, and I'll just kind of highlight them really quickly. If somebody wants to discuss it further, they can schedule a call with me, or we can do a follow-up video to this as well and dive into that. I think one of the things that has come into the game recently of private investment real estate is third-party administration. So it's kind of like having a referee in the middle. So an added layer of trust and transparency, and the potential for a Bernie Madoff scam. I mean, we all heard that horror story, and you don't want to get involved there. Sponsors who are skimming, or they're misappropriating funds or commingling funds in ways that they shouldn't be doing. But also the potential for real estate guys to make a mistake. I mean, the truth is, most really good real estate guys are also not fund accountants. So, adding a third-party fund administrator who's essentially a team of accountants that have they manage the capital, and they make sure that there's no funny business going on. So I think, seeking sponsors who've created that layer of transparency in the middle, where there's a neutral third party that reports exactly how things happen, and they don't have a vested interest in coloring it any different than what actually occurred. So that's something that sponsor or new investors might benefit from. Prior to having a long relationship with a sponsor, it's really nice to have a neutral party referee in the middle. I think another thing that is a value is to make sure that the sponsor's business is set up in a way where they're able to execute on the strategy. So finding good deals is only the very beginning. So you think about the potential for the investor return occurs when you buy the deal, but the realization of the return comes through the execution of the strategy. So if you're buying a property and the intention is in order to bring it from this value up to this value, that all of these things need to take place in the middle. Does the sponsor, have they designed their business in such a fashion where that's done on a very predictable way? Some businesses are very reactive and it's just panic all the time. And some businesses are very proactive and things are structured and they're built around processes and KPIs and it's a goal-oriented business, and that's the way that we choose to do it. So those are just a few other things that we didn't talk about.
Excellent. Well, again, if you guys want to find out more about Jack, 5210.com, or you can also set up a call with him. He's happy to do that, or a member of his team. So Jack, thanks again for your time, and I'm sure we'll be talking soon.
Jeff, thanks for inviting me, and have a fabulous Mother's Day weekend.